The Canadian government announced in November 2025 a new budget with an additional $25 billion allocated to the housing crisis, raising the total commitment to over $130 billion in recent years. In theory, this significant capital injection represents a major step forward to make homes more affordable and accelerate construction nationwide. However, a careful analysis of recent market data reveals that in key metropolitan areas like Toronto and Vancouver, the actual impact remains minimal, and the persistent crisis continues at an alarming pace. In this video, Housing Intel Canada will explain why the numbers suggest that the 2025 budget may not be enough to reverse the downward trend in sales, the stubborn prices, and the growing inventory of homes that simply fail to attract buyers. We will delve into why incentives and subsidies aimed at less problematic market segments do not address the biggest bottleneck, the lack of movement in the most valued areas, and the shortage of supply relative to increasing demand. If you want to stay informed with reliable, data-driven analyses of the Canadian real estate market, subscribe now to Housing Intel Canada. Get the latest and exclusive updates directly from official data, free from sensationalism. The 2025 federal budget, unveiled in November, highlights a massive commitment to housing with over $130 billion invested, financed, or incentivized since the beginning of the crisis. Notably, $25 billion was earmarked to accelerate construction and stimulate new projects, alongside incentives aimed at low- and middle-income families. However, breakthrough initiatives were scarce, with the budget repeating many measures announced in prior years, offering only incremental revisions and increased funding. The supply crisis, particularly in Toronto and Vancouver, remains stubborn despite softer financial assistance for rentals and home buying. Experts point out that bureaucratic hurdles in permitting new developments, rising material costs, and constrained labor in the construction industry limit the immediate effect of these measures. Furthermore, housing affordability hinges not just on funding, but on how effectively resources are deployed. Recent data from the Canadian Real Estate Association and the Canada Mortgage and Housing Corporation indicate that Toronto and Vancouver continue to suffer falling sales and stubborn inventory, especially in higher price segments. Toronto faces a record-high nearly 27,000 homes for sale, a level unseen since the mid-1990s, while prices have declined by 3 to 6% annually, depending on the segment. In Vancouver, despite government incentives, market conditions remain challenging, with thousands of new condos sitting empty and the benchmark price dropping nearly 3% year over year. The slowdown in new home construction is another critical element. Despite the significant budget, data shows a declining trend in housing starts in the Toronto area and insufficient delivery of units to meet current demand. This points to a lag between investments and tangible results, causing the market to progress at a slow pace. While Toronto and Vancouver face concerning stagnation, other Canadian regions continue to grow. Markets in Quebec, Calgary, Edmonton, and Montreal display increased pricing and construction activity, fueled by more effective local policies, affordable pricing, and greater emphasis on rental housing. This divergence underscores a complex national picture. Strategies that succeed in one province may have limited impact in large metropolitan areas, where prices, infrastructure, and population dynamics differ substantially. Understanding these contrasts offers insight into potential models for addressing stagnation in other urban centers. Beyond bureaucratic obstacles, the sector grapples with economic uncertainties that dampen investor and buyer confidence. Even with slightly lower interest rates, many anticipate deeper corrections before the market stabilizes. Most government incentives target less critical sectors like subsidized rental housing, which does not directly resolve gaps in middle and high-priced home ownership. Furthermore, local regulations and restrictions delay construction projects, inflating costs and slowing delivery. High entry barriers for new buyers also persist, including steep down payment requirements and tighter financing, limiting expansion in key market segments. For buyers, whether for personal occupancy or investment, it's crucial to understand that the crisis will not be quickly resolved. In the major cities, volatility continues with high inventory, limited competition, and prices fluctuating according to local liquidity. This demands a cautious, strategic approach to avoid losses and capitalize on real opportunities. Investors seeking growth prospects might find more stability in secondary markets such as Calgary and Montreal, where pricing and construction trends are steadier. It remains essential to monitor government policy changes and regulations that could influence market dynamics. The 2025 federal budget underscores that housing remains a priority for the Canadian government, but current measures fall short of resolving the most urgent bottlenecks. Toronto and Vancouver continue to struggle with supply, liquidity, and affordability challenges, while other regions prosper under alternative housing policy models. Effectively overcoming the crisis will require improved coordination between public policy and private markets, reduction of bureaucratic hurdles, and clearer resource targeting tailored to each region's unique needs. Until such integration occurs, buyers, investors, and real estate professionals must stay vigilant, informed, and strategically positioned. If you want to continue receiving the most accurate and up-to-date analyses of the Canadian real estate market, make sure to follow Housing Intel Canada. Trust data-driven insights that help you understand the market before it changes. And finally, please share your thoughts in the comments below about the 2025 budget and how you believe it will impact the housing market in the coming seasons.